Hi, it's Martin here with Wintrust Mortgage. Hope you're having a great day. Want to take a moment here to talk to you about a concept that can often be very confusing to our home buyers. And it may sound very simple, but it's not. And that is interest. Specifically, what is an interest rate and what is APR? How are they the same? How are they different? Really, what's the meaning behind these? Okay, so I'm going to try to break it down in a simple way and give you some guidance on how you might want to look at this, particularly if you're trying to compare a couple different loan options. Interest on a loan, okay, by definition, is basically the fee the bank is charging for you to be able to use their money. Okay, so if you have a $400,000 loan, you put in the interest rate of say 4% or 3%, whatever it is they're offering, amortize that over a period of time, and it gives you a monthly payment. The interest rate is what drives your monthly payment month in and month out. It's a very important number. You always want to know what that number is. Okay. Now, where it gets a little confusing and complicated is when we start looking at the term of APR. Now, by definition, that means annual percentage rate. And the idea behind APR is to be able to analyze the full cost of that loan, taking that interest rate plus all the fees and all the transactional costs that go into what it takes to get that loan. So in other words, how much money do you need to put in, or what do you need to give the bank in order to get that loan issued back to you? And in many cases, the idea behind APR was designed so that borrowers can compare different loans that may not always be apples to apples. So for example, let's say your lender is offering you an interest rate of say 4% with 0 points and 0 costs. But then somebody else is offering you a 3.75, which is a lower interest rate, but they're going to charge you some fees. Well, where are you better off? Okay, that was the concept, that was the idea behind APR. But the problem is APR has some inherent flaws in the way the numbers are calculated and the way the world really turns. And for that reason, I'm going to tell you, I don't really pay a whole lot of attention to APR. I'm not going to tell you to fully ignore it, but I will tell you, take it with a grain of salt. Look at it, and unless you're really good with numbers, you're probably not going to figure this out. Because here's the first flaw with APR. Let's assume you have some fees in your loan, which most people will have some number of fees. APR will calculate that in. Okay, let's say that the interest rate is 4%. You have an APR that's some weird number like a 4.23. All right, that 0.23 is being made up of all these extra fees that are having to be paid by you, the borrower. But what if you have some kind of a concession being offered to you? See, APR does not allow for a credit from, say, the seller to the buyer, which is very common. So let's say your realtor negotiates a deal where you're getting $5,000 in the form of a credit from the seller. The APR does not deduct that out. See, because the APR just doesn't have the ability to factor that in. So now your APR is showing this higher interest rate, but you're not really the one paying it. Somebody else is paying it. And that somebody else doesn't have to be the seller. It could be a realtor with some kind of realtor's fees that they're crediting you or something like that. So there's a lot of different things that APR doesn't take into consideration. But the biggest problem with APR is that it makes the assumption that the fees that went into the loan are being amortized over the maturity date or the length of that loan. So in most mortgage applications, that's a 30-year loan. How often is a customer really in the full duration of a 30-year loan? Very few people get to the end of 30 years and pay off that mortgage. Most people will either refinance the property somewhere in the 5 to 7 year range, or they will sell the property because they're moving up or moving down. Yes, there are some people that do see the full 30 years of a loan, but that's the rarity. And the problem with that is if you have an APR that's calculated to say, using my original example, 4.23, and you paid off that loan 15 years into it, now that cost was compressed and there's 15 years of interest that you didn't have to pay. And that is not reflected in the APR that you're evaluating at the time of origination with a loan. So that's where we start getting into that confusion with APR. So here's the way I like to address this with most borrowers. Look, use APR as a rough guideline. It's a number you're going to look at, but we're not going to get into completely breaking that down. What we want to look at is your monthly payment. Because at the end of the day, your mortgage has to fit your budget. And what you should be looking at is the dollars. Am I paying something to get a lower interest rate? Okay, that's something we need to look at. What's your break-even point? If I'm giving up $3,000 to get a lower interest rate, how long will it take for me to win back that $3,000 through the savings I'm getting through that lower rate. So that's something I would look at. The other thing I would look at is making sure that the monthly payment is something that you're comfortable with. Because at the end of the day, regardless of what interest rate or APR you get, if the payment doesn't fit your budget, you probably shouldn't be doing it. So that's just a very quick overview on interest rates and APR. I hope you find that to be helpful. As always, I'm happy to assist you if you need to do any kind of comparisons or have any questions about anything. We can help you in that regard. Please comment down below, reach out to me or call. Either way, I'm happy to help. And just don't let the paperwork confuse you. That's what we're here for, is to help demystify some of this for you. Have a great day. Thank you.